to have a really big entry space, perfect for a beer pong table.
Ooh. All right, welcome back to another edition of Financial Accounting. So I have you all on mute. If you need to holler at me, please make sure you unmute your microphone. Otherwise, you're welcome to just submit a chat message to me if you got a question about anything. I sent a bunch of emails to you guys yesterday. Just real quick, going down to the final exam information folder on Blackboard. You'll see there is a final exam set of review notes. Took me a while to get feedback from our course coordinator regarding what's the content on our final exam, but I got that information and I'm happy to give you these set of review notes to focus your studies. We'll talk more about this on Wednesday during Wednesday's class, which is also done via Zoom. There are practice exams available for you for the final exam, so you're welcome to start looking around at that. Just as a reminder, per the Texas Tech calendar, we have our final exam on, let's see here, I believe it is, let me back out of this real quick. exit, go to, come on, calendar, our class. There it is, final exam on December 9th. That information has been sent out to you. So different times for different courses. So I believe that the 12 noon folks take it from 1:30 to 4, and you folks take it from 4:30 to 7 p.m. So if you have any questions or concerns about that, feel free to let me know. I get some more people joining here in a second, so we bring those people in. So just for those people who just joined us, I was talking about our calendar, just making sure everyone knows and is aware of our final exam, which is on December 9th. That's coming up pretty quickly. So that's to help you prepare for that exam. I have uploaded information about that in the final exam information folder, and we'll talk more about the details of this during Wednesday's class. Also wanted to just remind everybody that for you guys and for my earlier class section, I get up to an 80% response rate for my classes here, for your class and for your class in particular. I need an 80% response rate in order to award you guys 5 bonus points. So 5 bonus points is about 1%, 1% bump in your grade. So if you haven't done your evaluations, please do so. I evaluate each class separately. So 80% is the target response rate I'm looking for here. I'm happy to give you updates as I go. Without any further ado, I want to jump into our lecture for today about the statement of cash flows. So it's been a bit of a break since we talked last. So if you're a little rusty, just want to make sure we're clear about the chapter 11 material about the statement of cash flows. The statement of cash flows is broken down into 3 different sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. These sections here can be broken up roughly by looking at the balance sheet and the changes in the different accounts. So in the case of cash flows from operating activities, we primarily look at changes in working capital. And by that, I mean changes in current assets and current liabilities. It tends to be the more difficult section to prepare, so we're going to look at that last. The cash flows from investing activities relate to changes in long-term assets, so like buildings and equipment. If we bought or sold any of those items, that the cash movements or cash flows from those transactions would appear in this area: cash flows from investing activities. Cash flows from financing activities relate to changes in liabilities, long-term liabilities, and equity accounts. So we'll look at that in more detail. So first thing is first, I recommend that we look at the easier sections first, just so that everyone is comfortable with how the statement of cash flows appears. So section 2, the investing activities. It's pretty straightforward. It's pretty intuitive. And the reason why is because we don't have a lot of transactions that involve the buying and selling of long-term assets. So if we do, usually they're pretty easy to spot. And generally speaking, if we do have any types of changes in our long-term assets, they involve cash movements. So if we look at it at the different items that could potentially result in a cash inflow or outflow, specifically, I want you guys to just focus on changes in long-term assets. There are changes in notes receivable and other investments, but the main one has to deal with purchase of long-term assets. So a cash outflow would result if we purchased land or buildings or equipment. And if you're to think about a transaction in which that would result in an increase in long-term assets, think about a debit to land and a credit to cash. That's a basic transaction there that would explain how land increased by way of paying cash. We also can purchase land by issuing a note payable. We'll talk about that later. But for right now, if you see changes in long-term assets where there's an increase, it suggests that we had a cash outflow. On the other hand, if you see a decrease, a credit to any of our long-term asset accounts, it implies that we probably got some cash for it. So Just going to keep these two journal entries in mind when you're looking at and analyzing changes in long-term assets. An increase suggests that we paid cash. A decrease suggests that we brought in cash. Debit cash, cash inflow, credit cash, cash outflow. How does it appear on the statement of cash flows? Well, as you can see up above, the plus sign implies a cash inflow. The minus sign implies a cash outflow. So sales of long-term assets, that's what we see down at the bottom here, the inflow. If we see sales of long-term assets, it means we probably got some cash. If we purchased long-term assets, it suggests minus a cash outflow. Financing activities are also pretty intuitive and straightforward because, again, there's not a whole lot of transaction or activity that affects these different accounts relative to operation. So when you think about financing activities, we're talking about debt and equity, long-term debt. So if we see, for instance, any stock issued or notes payable issued or bonds issued, that implies that we got cash. So we would debit cash if we issued common stock. If we paid out dividends, we purchased any treasury stock, if we paid off any notes payable or paid off any bonds payable, that implies that we see there was in a cash outflow. So if you see a decrease in any of our equity accounts, it implies a debit or also implies a cash outflow. If you see an increase to our equity accounts, it implies that we issued something and we got cash for it. But again, these transactions don't happen very often. Just realize that the pluses here mean cash inflow, sale of treasury stock, sale or issuance of stock, borrowing money, purchase of treasury stock means cash outflow, that's a minus. Payments are all minuses as well. So again, these seem pretty intuitive and straightforward, and they are relative to what we see next, which is cash from operating activities. Why is this so difficult why does this cause students generally so much frustration? The reason why it causes frustration is primarily because there are so many transactions that happen during the day, every single day the company is open, that it's impossible to tally up or track all the different cash movements. So is there a shortcut way for us to analyze the cash movements in our day-to-day operations? And there is. When we're looking at the statement of cash flows, all I want you to focus on is using what's called the indirect method. The indirect method says start with net income. Net income is revenues minus expenses plus gains minus losses. Yeah, there's a lot of accrual accounting that generates net income, but it's a close approximation of cash from operating activities. So we tend to start with net income as a point where we can start pulling out all the non-cash activities to arrive at what we will call a cash basis net income. So starting point, look at net income. Top line, cash from operating activities, net income, we will fill that number in. Then we ask ourselves, when we look at the income statement, are there any line items that clearly indicate non-cash transactions? Are there any items on there like depreciation that we can say are purely non-cash transactions? Recall that depreciation expense is a debit to depreciation expense and a credit, not to cash, not to the asset account itself, but it's a credit to accumulated depreciation. Amortization expense, we go ahead and credit the patent account directly. Depletion is where we reduce the long-term asset, put it into inventory, and when we sell that inventory, be it oil barrels, when we sell that inventory, it shows up as cost of goods sold. Losses and gains, generally speaking, those are book losses and book gains. There's not real cash movement associated with those specific items. So when we look at the income statement, we can say that let's go through and cherry pick those items on the income statement that clearly relate to non-cash transactions. I would focus, for your sake, especially for the final exam, on adding back depreciation, removing gains, and adding back any losses. There are cash effects from gains and depreciation, mind you, but realize that those items relate to investing activities. This whole section is about operating activities. So when we look at net income and we say, well, these are non-cash transactions, we need to remove those effects. What we're saying is we need to remove those effects from the operating activities section. We deal with those indirectly in another section. Once we cherry pick all the items, all the non-cash transactions on the income statement and remove those, the next step is to adjust for changes in current assets and current liabilities. Now, I will tell you that this is not very intuitive. We have to look at changes from somewhat of a transactional journal entry perspective. So I recommend when you're looking at changes in current assets and current liabilities, be able to recall the changes, the cash effects related to decreases in current assets and current liabilities. For instance, if we see a decrease to our current assets, what's a potential journal entry that would mimic that? A decrease to current assets would be a credit to accounts receivable. That journal entry would require us to debit cash, meaning that someone owed us money, we collected it, and we reduced that accounts receivable. So there, a decrease in current assets, if you just remember this rule, a decrease in current assets, think about as a cash inflow. In terms of a cash outflow, look at current liabilities and think about a journal entry that would mimic a decrease to current liabilities. A current liability could be accounts payable, or utilities payable, or taxes payable. Given that, if we see a decrease in a payable, what would the journal entry possibly look like? It would look like a debit to that payable account, and the credit must be to cash. We must have used cash to pay off that liability. So a decrease in current assets, think cash inflow. A decrease in current liabilities, think cash outflow. That's what I recommend you be able to recall or remember. If you see an increase instead of a decrease, just do the opposite. And what I mean by that is on the next slide. To understand the logic behind increases, consider the following transactions. An increase to current assets. What would be a journal entry that would mimic an increase to current assets? Well, if we purchase inventory or supplies, or we prepaid our rent at the beginning of the month, that would be a debit to that current asset. The credit usually accompanies a credit to cash or cash outflow. So if you see an increase to current assets, think cash outflow, as in we paid for something with cash and we got that asset. If you see an increase in current liabilities, think about this one particular transaction. Doesn't happen very often, but recall when a customer pays us a deposit up front, we record that cash as a debit to cash, but we don't record the revenue on the income statement. We record it as a liability to unearned revenue. So an increase to that unearned revenue liability account would be associated with a debit to cash. Increases in current liabilities, cash inflows. Increases in current assets, cash outflows. These are rules I think that are worth remembering, because if you come to the exam, you're going to be looking at a lot of different information, and it may help just to have these items or these rules in the forefront of your mind before you jump into the exam. It will help for us to look at an example, of course. So let's assume we need to create an income statement of cash flows using the indirect method. The first step we do is we start building out the cash flows from operating activities. The cash flows from operating activities starts with net income. In this case, the income for year ended 2018 is $50,000. So plug in a 50 representing $50,000. Then cherry pick, go into the income statement and cherry pick those items that are clearly non-cash transactions. The ones, like I said, I wanted you to focus on were things like depreciation, amortization expense. Those transactions do not involve cash. Gains and losses reverse those effects out. If we have a gain, how do we deal with it? Well, a gain increases overall net income. So if I have to reverse out the effect of a gain, because it's a non-cash transaction, I want to subtract away the gain from net income. If it is a loss or depreciation expense, losses and depreciation expenses reduce net income. So net income is lowered by depreciation and losses. How do we reverse those effects out? We want to add back depreciation and add back any losses. In this case, you're given information about depreciation. So adjustments to reconcile net income to cash provided by operating activities, we would write down depreciation and we would show it as a positive number. So the positive number here means, just think of it this way, as a cash inflow. We need to add back, but in reality, what we're doing is we're adding back $18 to the 50. The 50 was net of 18. We're reversing out the 18, reversing it out by adding it back. The gain was an increase to net income, so we are subtracting it out. We're reversing out the effects of non-cash transactions. Then we start going into current assets and current liabilities. Specifically, let's look at changes in current assets. In this case, we're given information about accounts receivable increasing 15,000. Well, granted, I told you to focus on remembering decreases. Decreases generally mean cash inflows. Accounts receivable increased. Okay, I know that accounts receivable, when it decreases, means I received cash. That would be a cash inflow. So this is an increase. I treat it as a cash outflow. Yes. Just for right now, remember that rule. If it's an increase of current assets, think cash outflow. Okay. Another way to look at this is prepaid expenses. Prepaid expenses increase by 1,000. Recall that journal entry where we had a prepaid rent increased. What was the credit in that case? It was a credit to cash. So again, increases in current assets, treat those as cash outflows. So down below in the purple, where you see increase in accounts receivable, an increase in prepaid expenses, you see that those changes are represented as negative numbers. Call them, if you will, cash outflows. In the case of inventory, notice that it decreased. That may not seem too intuitive to you. Why is that a cash inflow? Well, again, focus on the rule. If there's a decrease in current assets, think cash inflow. If it's an increase, do the opposite. So in this case, I'm just simply saying, remember that decreases represents positive inflows. Once we have those numbers in there, we're moving our way through the cash from operating activities section. What's the next thing we need to look at? Current liabilities. Don't be hasty when you're going through these problems. You're going to be looking at depreciation, gains and losses, changes in current assets, and changes in current liabilities. Go through the full set of information. Here we see accounts payable increased. Okay, that seems a little weird. How do I treat this? I know if I decrease accounts payable, a decrease to a payable means I must have paid cash. A decrease means outflow. Therefore, an increase must mean what? Must mean inflow. Just remember the little dynamics of these rules. You should be fine. Increase represents an inflow. Just go with it. Increase in accounts payable in purple down below, show it as a positive 34. What about the salaries and wages payable and the other accrued liabilities? Both those accounts decreased year over year. Okay, when I see accounts payable or any type of payable or accrued liability decrease, it suggests that I must have paid out some cash. So down below, where you see the decrease in salary and wage payable and the decrease in accrued liabilities, you see two negative numbers, -2 outflow and -2 outflow. Once you get all the way through current liabilities, you want to net all those changes together and compare that to net income. Net income started off as $50,000. Through all of our reconciliations, we're saying we need to add another 27 to the 50 to get what is considered true net income on a cash basis, otherwise known as cash provided by operating activities. Even though we have net income of $50,000 on an accrual basis, the true cash we collected from operating activities was actually net $77,000. This highlights why the statement of cash flows is so important. We can get a positive signal on the income statement of good performance. But when we look at the cash provided by operating activities, if it's higher, it potentially suggests that we're actually did a lot better than we're actually showing on the income statement. But also realize this too. If we do these reconciliations, it is also possible not only that we have to reduce net income to a lower cash from operating activities, but potentially, and I've seen this on roughly about 5% of cases on the stock exchange, 5% of firms that report positive earnings show negative cash from operating activities. It's a weird situation, but it is possible to see conflicting signals between the income statement and the cash provided by operating activities. But this is a good representation of our cash basis net income. Once we get through that, and again, that was the more difficult part of the statement of cash flows. The easier parts, I think, have to deal with financing and investing activities. So the very next section after the cash from operating activity section is to show the investing activities. So did we see any changes in our long-term assets? Did we have any changes in notes receivable or other types of investments? Purchase price of long-term plant assets, 196. Well, if I paid 196, I must have paid it in cash. So down below, you can see acquisition of plant assets, negative 196, meaning a cash outflow of 196,000. Pretty intuitive. I would say that these line items are a hell of a lot more intuitive than what you see in here with these changes in these account settings. That's why it's helpful just to be able to recall a rule or a tip. Here, these are a lot more intuitive. Acquired plant assets must have paid cash. We loaned money to another company. Okay, if we loaned money, cash must have gone out. If we received proceeds from the sale of something, it generally means cash came in. So when I net all those together, it shows that I have net cash used for operating activities of $155,000. Is that a bad thing? No, it's not a bad thing. Generally speaking, if you look at publicly traded companies and their statement of cash flows, 99% of the time, you're going to see a negative number here, meaning they'll have net cash used in investing activities 99% of the time. Investors and analysts like that. They want to see that the company is growing or expanding or improving somehow. And the way they do that is they spend money on buildings, equipment, patents, copyrights, etc. This is not necessarily a bad thing. Generally, it's a good thing. It's probably a bad thing if cash used for investing activities was a positive number, meaning cash was provided by investing activities. We don't want to see that really, because it suggests that we have maxed out all of our expansion and growth opportunities. And if we see a positive number here, we're getting cash provided by investing activities. It generally means we're downsizing, or we're selling off divisions, or we're selling off pieces of equipment or buildings to people. That's not a good sign. So we like to see a negative number there. So don't try to interpret anything more than just, it's just the math of how it works out. The company has information regarding its financing activities as well. So here, again, this is pretty intuitive. These line items are straightforward. There was a note payable that was issued for cash. There was issuance of common stock for cash for 4,000. There was a principal payment on a note payable for 11,000, and there was payment of dividends for 17,000. How do those line items appear on the statement of cash flows? It's actually pretty intuitive. Proceeds from the issuance of long-term debt. proceeds and proceeds. These are cash inflows. So plus 94 plus 4. Payment of, payment of. That implies cash outflow. That's why you see these negative numbers here. Net cash provided by financing activities. In this case, it's a positive number. Is it is that a good thing? Some people ask me, is cash provided by financing activities being positive, is that a good thing? And I say it depends on if the company is in the first year of operations or not. Generally speaking, when a company has an initial public offering and it issues common stock for the first time, it may be issuing common stock for the first and last time. You don't see a lot of issuance of common stock from companies. So that positive cash flow, you don't really see that in year 2 and beyond. Oftentimes, what we want to see is the paying the incur when we incur debt and when we pay it off. Generally, we incur more debt, slightly more debt than we pay it off. Overall, we want to see payment of dividends. We want to see a negative cash outflow for paying off dividends, especially if we want to keep our investors happy. They're going to want to see that we're paying off dividends. How do I attract new investors? I pay dividends. I show that I pay dividends, and I show how much I pay in dividends. So it's more common to see this positive, though it's not going to be that high. And it's okay if it's slightly negative because it just implies that we're paying off our debts and we're paying off dividends. Now, it is when we look at all these different parts and we bring them together, we want to compare them to beginning cash and ending cash. So if we look at our balance sheet and we see that beginning cash balance or last year's ending cash balance is 42, and we compare that to ending cash for the current year of 34, we see that there was an overall decrease in cash of $8,000. The cool thing about the statement of cash flows is you know you've done it right if all this math works out. I need to reflect the fact that there was a net cash amount used of $8,000 on the statement of cash flows. How do I do that? I look at the net cash provided by operating activities. That was $77,000. The net cash used in investing activities was a cash outflow, $155,000. Net cash provided by financing activities was $70,000. You net all those together, and what do you get? You get a net decrease in cash of, guess what? $8,000. We put as the next line item below that the cash balance as of the beginning of the year or last year's ending cash balance. The beginning of the year cash balance was 42. We used 8, so we must have how much left over at the end of the year? We must have 34 left over. The cool thing again about this is you know you've done it right if this math ties back to the balance sheet. Here are some other considerations, and primarily I just want to clarify, there are some more complex topics that I don't intend to test you on the final exam, but you'll probably see them in your homework. Okay? And the reason why is because it helps strengthen your understanding of the statement of cash flows. You may come across problems where there's significant non-cash financing or investing activities. What does that mean? Well, investing activities, financing activities, generally those don't happen too often. Generally, those changes in long-term assets involve cash outflows. Financing generally involves cash inflows or outflows. Why would they be non-cash? Well, think about it like this. You see an increase to a long-term asset equipment of some amount. Generally speaking, you can look at that and say, oh, that must mean we paid or credited cash for that equipment. I tell you explicitly in the problems on the homework whether or not that change was actually due to something other than cash. So you recall from, I believe it was chapter 7, when we bought equipment, we can usually buy it on account or sign a note payable, borrow money, or promise to pay back the manufacturer later. In that case, debit equipment, credit note payable, there's no cash involved. But it's tricky because if you look at an increase in a long-term asset, your first instinct is to say that it must be a cash outflow. Just be on the lookout for additional information about changes in long-term assets, whether or not they actually affect cash or whether or not they were acquired by issuing a note payable or common stock. The reverse is also true. Generally speaking, when we see an increase in notes payable or common stock or bonds payable, generally speaking, that means we debited cash. But here you can see we can credit notes payable or common stock and get something other than cash, in this case, equipment. So just again, be on the lookout for some sort of explicit information in your homework that tells you, oh, there are certain changes in equipment and or notes payable or equity accounts that were significant non-cash activities. Again, I don't plan to test you this in the final exam. I just mention this because it may be something that you encounter in a problem or two on your homework. Under the direct method, how does that differ from the indirect method? Well, first and foremost, yes, the book talks about the indirect and the direct method. It's worth noting that the FASB and the SEC prefer the direct method. But if you look to see the actual likelihood that companies will use this, it's more like 98% of the time they use the indirect method. The other 2% of the time they use the direct method. So it's the indirect method that I want you to focus on for the sake of the final exam. You might get a few homework problems asking about the direct method. It's good practice to help you understand and interpret changes in different accounts. So how does the direct method compare with the indirect method? The indirect method is up at the top. We just walked through this, so there's no need to really explain this anymore. Under the indirect method, you have to be given explicitly more information to complete the cash from operating activity section. So here in the direct method, the first line is not net income. We're going to go through and directly tally up all the cash receipts from operating activities. So if we collected cash from our customers, those are like the credits to accounts receivable. If we collected interest, if we have interest receivable or collected interest from notes receivable, those would be cash inflows as well. That information is usually given to you explicitly. Sum those up, those are your cash inflows from operating activities. What about cash outflows? Well, like you said before, it's possible that we made payments to suppliers, to employees, to the federal government, to our banks, related to all these items. If you have that cash outflow information, you want to show those as negative numbers, meaning cash outflow. You net those two numbers together, and guess what? You still show net cash provided by operating activities of 77,000. It's going to be the same overall cash from operating activities. It's just shown differently because you're given different information. Just be aware of that. Now, I'll tell you this as well. When you're comparing the indirect and the direct method, the only way those two methods differ is from the cash from operating activity section. That's why I wanted to highlight this here to you. The amounts are going to be the same overall. It's the presentation of those sections that differ. But the investing activity section and the financing activity sections, those appear the same under the direct method. So don't worry about those being different. Now, that's all I had for the sake of this lecture. You're welcome to log off and start working on that homework. Jump on it while this stuff is still fresh in your mind. If you want to stick around and ask me some questions, feel free to do so. Just realize you're on mute. I'm going to post this lecture up on Blackboard as soon as we are done here. So again, you're welcome to log off.